Hi, everyone. Welcome to today's program, Reorganizations of LLCs and Other Tax Partnerships, the Basics. My name is Asel Mukeyeva, and I will be moderating today's program. This program is brought to you by the American Bar Association Young Lawyers Division and its Tax Law Committee. The ABA is the largest legal community in the world with more than 400,000 members. Joining us is Matthew Rappaport. Matthew concentrates his tax practice in the areas of real estate, corporations, partnerships, and trust and estates. He advises clients regarding tax planning and structuring for generational wealth transfer, commercial real estate enterprises, business transactions, and cross-border considerations. Matthew graduated from Washington University in St. Louis in 2007, cum laude, with an undergraduate degree in political science. His undergraduate thesis was a cross-sectional analysis of the corporate culture of the privately held financial firm Edward Jones. He received his Juris Doctor and Master of Laws in Taxation from Georgetown University Law Center in 2011. Matthew is licensed to practice in New York and is an active member of Nassau County Bar Association, the New York State Bar Association, and the American Bar Association. He serves on the Sales, Exchanges, and Basis Committee of the American Bar Association section of Taxation. Matthew has authored articles for the Nassau Lawyer, Thomson Reuters Journal of Real Estate Taxation, the Tax Advisor, Bloomberg's B&A Tax Management, Real Estate Journal, and the Journal of Taxation of Investments. He has spoken at the request of the American Bar Association, the National Conference of CPA Practitioners, the Financial Planning Association, Stafford Publications, the School of Accounting at LIU Post, and a wide variety of law, accounting, and wealth advisory firms. He is the founder of the Young Professionals Networking Group Hydra Collective. Matthew, I'll turn it over to you.
Asel, thank you very much. I realize now how much cooler that bio makes me sound than I actually am. Thanks a lot, everyone, for joining us. Thanks especially to Asel, to Vlad France, whose idea it was to put this webinar together, and to Tracy and the ABA. Tracy, you've been a real pleasure to work with, so thanks for setting this up for us. You'll see here that the theme of the presentation is a basic overview of the tax considerations in reorgs of tax partnerships. What I'm assuming is that everybody knows at least some sub-K. If you don't know sub-K at all, then this is probably going to go a bit too quickly for you. But I assume that people are not necessarily masters of the subject, so I'll go into a little bit of detail on some sub-K concepts when necessary. For those of you who don't have much experience with these, they're very nifty. The more the light bulb goes on and you know what they are, the more situations you'll realize that they're very useful in planning for a wide variety of clients in a wide variety of situations. It comes up in estate planning. It comes up for planning for real estate, including 1031 exchanges, in breakups of business enterprises and investment enterprises that are structured as tax partnerships, and then, of course, in regular old M&A deals. This is going to be a bit of a whirlwind tour. For those of you who reviewed the materials in advance, if you had the opportunity to do that, they're in narrative form, they're packed with information, and we will not be able to go in depth on everything. Although I do certainly advise you to download these and keep them handy, because you can always refer to them as a handy guide in case you want a nice overview of things in the form of about 60 PowerPoint slides. But we're going to go over really 30,000-foot views, high-level concerns, and it's not going to give me a great deal of time to drill down into extensive detail. What I want to do as a goal here is give everybody a framework for identifying the tax and other issues, some other peripheral issues, that come up in these transactions. So if you're able to get a sense of what you should be looking for when you are part of a deal team that is dealing with a reorg, then I think I have accomplished my goal. Feel free to send in questions. I'm going to try and leave at least 5 to 7 minutes at the end to address them. And I will, I believe, since this PowerPoint is designed, really was first designed for an 8-hour seminar, then I trimmed it down to 3, and now it's down to 1. It's likely I may have to skip some stuff, but I want to at least hit the essentials. So I'm going to keep a very close eye on the clock and jump right into it. So I'll start by just going over very quickly the types of reorganizations I'm going to cover today. First, of course, is a recap, which many of you probably know from the corporate context, in which the partners generally are going to stay the same, but the nature of the deal is going to change somewhat. I just listed in bullet points here some of the things that may change as a result of a partnership recapitalization. You've got liability limitations to the partners, the ability to vote, whether or not a partner has a certain proportion of capital and profits interests, those might change. Return on capital, the rights to distributions of profit and loss, the return of capital, the rights upon liquidation of the partnership, options, ancillary rights, that sort of business. In a merger, you have a combination of two or more tax partnerships into one. So mergers will result in the technical termination of at least one, and most likely the continuation of at least one, although there are rare instances in which every merging partnership will be considered to terminate. And then, of course, there's divisions. One partnership will split into at least two, and unlike mergers, the termination and continuation can take many forms. You can have the prior partnership terminating entirely, you can have the prior partnership continuing in the form of one resulting partnership or in multiple resulting partnerships, as you'll see later. You'll notice these have analogs, right? Recaps, of course, are in the corporate context. Mergers are in the corporate context, and divisions are best analogized to the corporate context in the form of, Section 355 transactions like spin-offs and split-ups and that sort of business. So the code allows you to do these things with partnerships, but the guidance is a lot more scant, and so the issues are tougher to wrap one's head around. What I'll say as a preliminary consideration is that while there is no specific tax deferral rule, there's no analog of Section 368, there's no analog of Section 355, generally partnership reorgs are tax deferred. There's a section of the regulations under Section 708 that will deal with accepted forms. I'll go into those later. But other than a guide as to form of transaction, there's really not a lot in the regs that directly deals with reorgs. You have to go to the other parts of Subchapter K and then apply those principles in the reorganization context. Under Section 721 and 731, which I assume most people are familiar with, contributions to and distributions from partnerships are generally not subject to income taxes. So mergers and divisions, since they're just combinations of the two, you'll have contributions to a new one and distributions from a new one and so on and so forth. Generally, mergers and divisions are going to be tax-deferred transactions with carryover basis. On the other hand, you have recapitalizations, again, generally not resulting in recognition, but there are certain issues you need to watch out for in the context of every reorganization that may result in income tax recognition. And the nasty part is that not only may it result in recognition, it would result in recognition without the corresponding cash, otherwise known as phantom income. What do you have to spot generally, just as a broad overview when you're planning one of these transactions? You have to look out for economic shifts. You have to look out for them in general with any transaction or other matter that deals with Subchapter K. But what types of economic shifts specifically are we looking out for? You have, of course, a capital shift. What does that mean? It means your rights to partnership capital are going to change. So if Asel and I go into a 50-50 partnership together and we have 50% rights to partnership capital, and then if we either through a recapitalization or a merger or division go into a new partnership in which our legacy property, if we've got the Asel and Matthew partnership and it's got a building in it, if we end up with rights to less than 100% of the building in the aggregate, so Asel and I are 50-50, our 50-50 partnership owns 100% of the building. Well, if we merge into a partnership and we have less of the capital in that partnership than the value of that building, then the capital has shifted to our new partners who have merged in with us. That's a problem. That's going to give rise to some level of recognition under one of the many rules I'll go over today. Liability shift, economic risk of loss has now changed. So Asel and I are in an LLC together, taxed as a partnership, it's 50-50, and all the debt is non-recourse. But then as part of a merger deal with a second partnership, I go ahead and I guarantee all of the debt that was previously non-recourse. That's a problem. Insofar as it will result in a liability shift, and you have to account for those consequences under Section 752. Profit shift, your rights to future partnership capital, appreciation of value, future profit loss distributions, those change around. That might have consequences. And then, of course, you might not have a shift in value. You might have, if Asel and I are in a 50-50 partnership and our building is worth $1 million, if we merge into a new partnership and we still have rights to $1 million of capital, except now our rights are not to the building, our rights are effectively to a different building, that's a problem too, because we now are considered to have rights to different assets. So whether or not it's a mixing bowl or a disguised sale issue, that's a problem. So what you should get a feel for is you should get a feel for comparing before and after. What are the partners' rights in both certain assets and in profit loss distributions and these other items before a reorg occurs? And then you have to evaluate what the rights are after a reorg occurs. And if those rights are fundamentally different, then you may have recognition or other adverse tax consequences. So this is a nice handy list of what you should keep in mind on a macro level. As far as tracking tax attributes, this is important. These are going to allow you to get a feel for stuff that may have changed in this before and after comparison, right? What do you need to constantly be keeping in mind? And I'll say this one thing. If you're like me and you're working with a lot of small and mid-sized accounting firms as part of a deal team, this stuff is not always going to be tracked and tracked accurately. Sometimes accountants are just not going to realize it's important to keep track of one or more of these items, and you may have to go back and reconstruct the record yourself, or you may have to do some more digging with the client in order to figure out how to track all this stuff. If you're working with big four accounting firms or major regional firms, they're better about this stuff generally, and they'll also have their own tax lawyers in-house who will be tracking this stuff rather carefully. But that's not to say, of course, that you can apply that generalization to every single accountant that you might work with. But this is the list of stuff that you ought to be tracking as these transactions unfold. You have your inside basis, partnership's basis in its own assets. You got outside basis, which is the partner's basis in their respective partnership interests. That in the aggregate should generally be the same. You have Section 754 elections available to correct any disparities, but it doesn't always work out that way. Capital accounts, which are tremendously important. Of course, tracking the economic arrangement among the partners, which is spelled out in the 704 regulations. You have your liability shares, economic risk of loss, and for non-recourse, you'll have your own, for non-recourse, they'll have their own method of allocating those under 704 and 752. You have to track liability shares as well, and then you have to track partnership minimum gain, which is the way of keeping track of the chargebacks for the benefit of non-recourse deductions. In addition to that, you've got holding period. Not only inside holding period, partnership's holding period in its assets, but outside holding period, the partner's holding period in their respective partnership interests. Mixing bowl consequences. Do you have any pre-contribution gain or loss under Section 704 or 737 that needs to be tracked back to partners? Recapture. Section 197, Section 1245, Section 1250, and investment tax credits. Tracking whether or not any of these need to be recaptured upon a deemed disposition of assets. This is very, very big with real estate, and it's very, very big with intellectual property. Then, of course, you've got your hot asset rules. Unrealized receivables, inventory, and for purposes of Section 724, capital loss assets that are contributed to a partnership by a partner. All this stuff should be in a massive Excel spreadsheet somewhere in order to allow you to, again, make these before and after comparisons and make sure that you can put an eagle eye on each of the issues that needs to be addressed in order to make sure that no adverse tax consequences will result, or if they will, trying to plan around them as best you can. So with that out of the way, let's go into the forms of transaction that are accepted under the regulations. Assets over and assets up are the two types of forms that are accepted in in the regulations for both mergers and divisions. Reorganizations which don't involve multiple partnerships, you don't need to know these forms for purposes of recast. But for mergers and divisions, there's two forms. You've got assets over and assets up. You'll see here that assets over is the form by default. If you don't execute assets up exactly correctly, even though you have certain transactions occurring for state law purposes, the tax law doesn't care. That's a common theme in reorgs. The tax law will simply say these are the transactions deemed to occur regardless of state law form. So what happens in assets over is the inside basis is going to, the partnership's basis in its own assets will carry over to the interest in the partnership merging, and an outside basis will not be a relevant consideration. When is this the right option? If you do have a basis disparity that favors inside basis, and if there's no economic shifts because you really have trouble controlling mixing bowl and disguised sale consequences in this form. In addition, if you don't have any concerns with real property transfer tax and liability exposure, that's important, because if you're using assets up, you have to distribute the assets out of the partnership, which I will illustrate in a moment, in order to execute that form correctly. Well, even though there's momentary ownership, that may have liability implications, and it may have implications when it comes to certain states' real property transfer taxes. So these are the considerations you want to look for when deciding between assets over and assets up. What does the form look like, right? You've got red partnership and green partnership. They want to merge. You have gold and sky are the partners of red. You have brown and purple are the partners of green. What's step one? Green is going to take interest in its partnership and exchange them for the assets and the liabilities of red. So the exchange will be interest in the green partnership will now go to red, and all of red's assets and liabilities are going to be contributed into green. And those will be exchanged directly for each other. In the second step, now red will take its green partnership interests it just acquired, and it'll distribute them in liquidation of red partnership up to gold and to sky, and that will be the termination of the transaction. So a relatively simple transaction form from 30,000 feet, but when you see all the collateral issues that come up, it starts to get pretty difficult to wind this stuff down. So what's the result? The result is you've got gold, you've got sky, you've got brown, and you've got purple. All of them are now the partners in the new green partnership, which survives. So that's, again, I'll recap it by going back to the last slide. You've got a contribution of all of red's assets and liabilities in exchange for interest in green, which when you liquidate red and distribute the green partnership interests up to gold and sky, you have two new partners of the green partnership, which will then survive, and that's your end result. On the other hand, you have assets up. Assets up, again, is not the default. You have to execute it exactly right in order for it to be respected. In this form, outside basis is now the relevant consideration. You'll distribute all the assets up to the partners, and then the partners will contribute their assets into the new partnership. So inside basis, no longer really a relevant consideration. When is this right? This is right, of course, when you have a basis disparity the other way. Outside is greater than inside. And here, the big thing with assets up is you can customize who is going to receive what in liquidation. When you have an assets over transaction, you are contributing the assets basically, for lack of a better term, pro rata into the new partnership. So I'll go back to assets over. In this transaction, basically, when red contributes the assets and liabilities into green partnership, the thing with gold and sky is if there are going to be some triggering of consequences for them based on the idea that if they're, let's just say, gold and sky are me and Asel, and I'm 60% and Asel is 40% of capital and profits, then when we make the contribution into green, the problem that we may run into is that if we have if we had pre-contribution gain or loss, if we had contributions of certain assets that may trigger disguised sale consequences and all sorts of other nasty business. We can't help the idea that all of those assets and liabilities are being contributed by RED, which, if you follow the aggregate theory of partnership taxation, is 60% my ownership, 40% Asel's ownership. That's all going straight into green, and we can't figure out in liquidation who's going to get what assets. And as I'll illustrate for you when we go over mixing bowl and disguised sales and some other considerations, you've got all sorts of problems if you can't control who's going to receive what when everything is liquidated. And so if you have concerns about any of these economic shifts, disguised sales, upon the liquidation of RED partnership in that example, you want to use assets up, because if it has to be that I get back my asset with pre-contribution gain or loss, whether it doesn't even have to do with recognition, it just has to do with convenience purposes for accounting, I can, in liquidation, make sure that I get back that asset in order to contribute it into the new partnership, and it might be a much cleaner transaction. So the way that assets up is going to work is step one, RED will liquidate, and instead of the assets and liabilities going to green partnership, it's going to go to gold, it's going to go to sky, and then they're going to it's going to be a temporary, momentary ownership. It's transitory. It has nothing to do with like you would in a drop and swap on a 1031, establishing 30 days of ownership or something. There's no need for that. The regulations give you the ease of just having a momentary ownership in the name of yellow and blue. The only problem is, of course, that ownership does actually need to occur. So you can't go ahead and pull a let's not and say we did and say, yeah, it all ended up in green, and for state law purposes, it was transferred there directly, but we're just going to say that they owned it. You can't do it that way. For state law purposes, you have to liquidate RED. Gold and Sky have to get title to those assets, and they have to make an immediate contribution into green. That's step two here. They take all the assets and liabilities that they inherited from RED in liquidation. They make a contribution to green in exchange for green's partnership interest, and green survives. And that is the way that an assets up transaction is going to work. So there's subtle differences between the forms. But at the end of the day, there are key differences depending on the specific facts and circumstances of each individual transaction. One of the things to note here when you're choosing forms, and again, just as 30,000-foot issue spotting, tax law form and state law form are really not connected, except for the idea that in assets up, the partners in the liquidating partnership need to temporarily and transitorily own the liquidating partnership's assets and liabilities. So that gives you the nifty opportunity to structure a transaction for state law in many different ways, just from a state law point of view. And it'll default to assets over for tax purposes. And you can probably get the gears turning in your head, and you can think of the opportunities that this presents when you want certain state law goals to be accomplished, but for tax purposes you're aiming for a certain treatment. You can thread the needle and you can prescribe a certain state law form and have the comfort of knowing that if it's not the exact assets up form, it'll just default to assets over. So you can think of things like, certain entities will have certain licenses. They'll have certain contracts. They'll have grants from the government. They'll have woman-owned business enterprise certification, minority-owned business enterprise certification. All these different things where people say, for state law purposes, we don't want to break this up. Great. Well, given that there's a tax recharacterization under a default assets over form, we have a fair bit of customization while still getting the tax results we want, which when you're planning these transactions ends up being pretty cool. So when you're going ahead and you're getting together with the deal team for the first time, certainly keep that in mind. And that's why in the title of this slide I underline tax, because it's the tax form, it's not the state law form. You can have many state law forms with the same tax form, and as long as you're aiming for an assets over form, it'll work out the way you want. So that's pretty cool. What is the key? What's the first key thing to track when you're putting these together? It's the question of which partnerships will terminate and which partnerships will continue. Why does this matter? I go over this in a later slide, but the problem is that terminating partnerships end up having a wind down under Section 706 of all the affairs for tax purposes. And in addition to that, you will have to restart the depreciation and amortization schedules on the assets of that terminating partnership because they're considered to be placed into service again. So you have to be careful about continuation versus termination for those reasons, and then there's some ancillary reasons like getting new EINs and things of that nature. So how do you figure out which partnerships will terminate and which partnerships will continue? Well, for mergers, one of them is always going to terminate. Possibly all merging partnerships will terminate, but to determine which, if any, are going to continue, first, see whether or not any merging partnerships partners own more than 50% of the final merged partnership. If they do, that partnership continues, the rest of them terminate. If two merging partnerships combine and each of them have an equal 50% interest in the merged partnership, net asset value, NAV, is going to be your tiebreaker. So whichever one brings in the highest net asset value, that'll be your tiebreaker. And then third, if nobody owns more than 50%, all of them will terminate. So the rules are relatively rudimentary, but just make sure you go through the motions and make sure which partnerships will continue and which ones will terminate. What's the impact of any boot, right? What if you get a payment in exchange for the merger and not just partnership interest? You'll see here you can get cash, you can get marketable securities, you can get hot assets, which are inventory or unrealized receivables, and you can get reduction in liability shares. All these things are boot. The problem with boot is that unless, I did say it results in recognition to every partner. Not always the case. It's not the case 100% of the time, but you're going to have gain recognition usually to every partner under Section 704B, because if you try to accomplish this with special allocations, for those of you who know what fill-up allocations are and all sorts of other stuff, it's very uncertain as to whether it's going to work. Granted, if you do have a taxable gain flowing through, you might be able to get basis recovery, but if you don't have sufficient basis, you'll have some recognition, possibly in the form of phantom income. There is an exception here that you should know about. If you have one partner out of a merging partnership who wants out, the regulations, I gave you the citation there, 1.708-1C4, that gives you the steps on how to do what's known as a boot merger. So if you've got a partner cashing out, you can allow that partner to cash out without any recognition of gain to the other partners, but you have to do it exactly right. The service sets forth a very narrow set of qualifications for how you're going to structure that, and you have to follow the regs very, very closely. If you accomplish it, then only the partner cashing out will recognize gain, and it'll have the effect of a fill-up allocation, which is good. So as far as tracking tax consequences, as I explained earlier, just keep in mind tax law and state law can be completely different here. You can have one form for state law purposes, and then the tax law will deem certain transactions to occur, and this can get really confusing really quickly. So what do I mean by that? You can have, if Asel and I are 50-50, and Vlad France and Tracy are 50-50 of another partnership, we can say, let's just say, we go into a new partnership and then each of us is 25% partners, right? So going back to our continuation and termination rules, right? If we both come in and own 50%, highest net asset value wins. Well, let's just say that we stipulate for state law purposes, the Asel and Matthew partnership will survive and the Vlad and Tracy partnership will terminate. We can do that for state law purposes. But if Vlad and Tracy have a partnership with higher net asset value, for tax law purposes, they survive. So that the weird outcome of that is that the Vlad and Tracy partnership has survived for tax law purposes. The Matt and Asel partnership has survived for state law purposes. And the Matt and Asel partnership is now inheriting the Vlad and Tracy partnership's EIN. That, for the accountants who are not supported by a large firm law departments, the law department of a KPMG or a PwC, that can get really confusing really quickly. So you have to map out tax law and state law totally differently. And just make sure, if, for those of you who are accountants, make sure you've got this stuff, the last 4 bullet points under wraps. If you're the attorneys, you have to go and double check with the accountants to make sure that the terminating entity undergoes the following procedure. The terminating entity's tax year is going to end. You got to close out the tax year. The tax ID number is no longer necessary. It'll go by the wayside into the ether. And under Section 706, all the terminating partnerships affairs are going to get wound up. So you got to follow all the dictates of Section 706 for the terminating partnership. Tax elections are going to terminate. What's the most relevant? Section 754. On the terminating partnership, if the Section 754 election is in place and it merges into another partnership, it doesn't matter if the terminating partnership had a Section 754 election. If the surviving one had no 754 election, you got to make a 754 election all over again if you want one. Then, of course, the big one, depreciation and amortization schedules are restarting under Section 708. And that, for a lot of people in the real estate industry and some other industries, will be a real pain. So you got to be mindful of these consequences, not only to make sure that the accountants are going ahead and doing them right, but you also have to make sure that this will not adversely affect any of the parties, especially your client. So, given that you've seen the assets over and assets up forms for partnership mergers, it's a breeze to go over them for divisions, right? Same concepts. Assets over is the default. Inside basis is going to carry over. Outside basis, no longer relevant. Probably the right option. You've got basis disparity, but then you've also got the economic shift concerns. It's all the same as assets over mergers. Generally speaking here, you can't control what the consequences are going to be for all these economic shifts and disguised sales. So if you want to control them, better to do assets up. What's your form, right? Same analog as mergers, but we're doing it in reverse. We start with the green partnership. Gold, sky, brown, and purple are all the partners. We're going to take some of the assets and liabilities out of green, and green is going to contribute them into the newly formed red. Red is then going to take its partnership interests and give them entirely to green. Then what green is going to do is green is actually going to redeem out or liquidate out the interests of only gold and sky, and they will receive only red partnership interests. So I'll recap that again, right? Take the assets and liabilities that are going to be divided, contribute them to newly formed red, and then red goes ahead, takes its interests, gives them back to green, and then green liquidates out or redeems out the partners who will receive the divided or the new red partnership interest. And now your results, which I should have put in the diagram, your result is you've got green partnership with brown and purple. You've got red partnership with gold and sky. Although keep in mind, in this example, gold and sky have been liquidated out. Theoretically speaking, you could have a division of a partnership in which none of the partners are redeemed or liquidated out. You could have, you could divide a partnership in which all the partners are staying together. They just want their assets in different partnerships. Give you another example. It's me, it's Asel, it's Vlad, and it's Tracy, all in the green partnership. Let's say the green partnership's got 2 buildings in it, right? We've got an LLC. We're not really sophisticated investors. We haven't had high-level sophisticated advice. And we've got 2 parcels of real estate in the same LLC, 3 parcels of real estate in the same LLC. And somebody turns around and says to us, hey, don't you realize that if there's a liability arising from one of these properties, all 3 of them are on the line? Wouldn't you like to have each of them in separate cells in order to go ahead and protect them from an asset protection standpoint? One of your options, you could of course just form DREs right under the partnership, but if you didn't want to do that, one of the things you could do is do an assets over and assets up division of our partnership that would then split into 3, each of which owns 1 property. And in that one, we would be taking the, let's just say we had the green partnership and we were forming red partnership, and we formed blue partnership, and those were our 3 partnerships that were going to hold each of our parcels of real property. we would divide, and when the parcels are contributed, one to red and one to blue, when we make those distributions of red partnership interests and blue partnership interests, they're made, you know, a quarter, a quarter, a quarter, a quarter to all four of us. But green partnership is still around with all four of the same partners. It's just going to have only one property left in it. So, so you don't necessarily need to liquidate or redeem the partners in a division. You just need to distribute out. The interests that are going to be divided. So, so how's the assets up form going to work? Same idea, right? I'll go straight over, because these considerations are all the same. I'll go straight over to the diagram, right? You're going to instead distribute assets or liabilities. Could be in complete liquidation, could be otherwise. In yellow and blues, interests, or golden sky, I've been calling them. And you know, once the assets and liabilities that are going to be divided are distributed up, you have transitory ownership of those assets and liabilities, and in step two, they get contributed to newly formed red partnership, and now your end result is illustrated here. Golden sky are the partners of the brand new red partnership, and brown and purple are partners of the brand new green partnership. So you've divided green partnership into two. Continuation and termination works a little bit differently than it does in mergers. You can have the prior partnership either continue or terminate. It can continue in many forms. How do we check what the continuation and termination consequences are going to be? First, you got to check whether the members of the resulting partnership owned more than 50% of prior partnership in the aggregate. And again, if they did, it's a continuation, and you can have that in multiple resulting partnerships. So if you divide one partnership into three, in the example I used before with 3 parcels of real property being divided into 3 partnerships, all of them are a continuation. If none of the resulting partnerships have more than 50%, prior partnerships continue to terminate, and both resulting partnerships are brand new. So keep in mind that the thing here to note is that in this example that I just went back to, you may have 2 new partnerships for tax purposes, 2 new EINs, and so on and so forth. So the continuation and termination rules are a little bit different for divisions than they are for mergers, and you got to go through this checklist and make sure you've got the continuation and termination down correctly. Keep in mind, of course, again, tax law and state law can differ entirely, so don't necessarily pay attention to the deal paperwork and the deal diagrams from the non-tax attorneys, because those consequences may just throw you off. At the end of the day, go through the checklist and look at everything in a bubble to determine continuation and termination. What happens if 2 partnerships continue, right? That's the natural question. The natural question is, well, I've now divided, and now I've got 2 continuing partnerships, so what happens as far as EINs, taxable years, in that business? Again, the tiebreaker is greatest net asset value. So the EIN, the taxable year, are all going to go to the resulting partnership that has the highest level of net asset value. For all the other ones that continue, they're just going to get a new EIN. They're going to start a new tax year beginning the day after the division occurs. So why is this relevant as far as continuation? Tax elections, so 754 elections in particular, are going to stay in place, and the depreciation and amortization schedules are going to continue, which is always nice. So you still need to determine continuation and termination, even if you've got multiple continuing partnerships. Again, make sure the accountants are tracking everything. You can look over their shoulder, and don't, like I said, don't look to transactional documents for this issue only. Do look to them for the other issues. But on this issue, it's going to confuse the hell out of you. What do I do? There I go. It's just going to confuse the hell out of you. When you analyze continuation and termination, diagram this stuff out in a bubble. Go to the slides that I just recapped, and make sure that you go through the checklist item by item, and that'll lead you down the right path. If you're going to look at diagrams from the other transactional attorneys, it's going to make your head spin. What else are we watching? Holding period, right? Generally speaking, holding period is going to track with basis. If it's a carryover basis transaction, it's carryover holding period. The thing that you have to watch out for is, in an assets over transaction, if some of the partnership's assets had a a long-term holding period, and some of them had a short-term holding period. You've got to do percentages by NAV, net asset value, and you've got to then split the holding period of the interest in the new partnership. So, if we've got the merger of red and green, and green survives, if red's assets were 10% short-term holding period and 90% long-term holding period, then the interest in the green partnership that the red partners are going to receive have a split holding period. So if they immediately go off and sell their new green partnership interest, it's 90% long-term capital gain, 10% short-term capital gain. So keep that in mind. The holding period regs spell this out a little bit. But you have to keep in mind, if you've got split holding period inside the partnership on an assets over transaction, then you're going to have a split holding period for the new partnership that you'll receive the new partnership interest that you'll receive in return. Recapture. If you've got a recognition event, you're going to recognize this recapture. You've got to make sure, again, that this stuff is tracked. And then for investment tax credits under Section 50, these regs are really weird. There's some case law and there's some articles on this. If you want the material, email me directly and I will give it to you. There is a weird anomaly in the regulations that states that basically what it says is, in effect, recapture of investment tax credits will occur upon any merger or division, period, end of story, except for possibly properly structured assets over mergers. So for assets over divisions, assets up divisions, and assets up mergers, you're going to have recapture of investment tax credits. Again, if you want to discuss that further, just email me. I'm not going to go deeper into it than that. Mixing bowl. Mixing bowl is its own enormous topic. Most of you are probably familiar with the general aspects of how this works, right? What is the theme of this? The theme of the mixing bowl rule says, if Asel and I go form a partnership and we're both contributing real property, I have a basis of 0, fair market value of 500. Asel's property has a basis of 300, fair market value of 500. I got a built-in gain of 500. Asel's got a built-in gain of 200. We go ahead and we form the Asel and Matthew partnership. We say it's going to be a 50-50 partnership, and we each contribute our properties to it. The general theme is that for 7 years, that built-in gain, 500 to me and 200 to Asel, has to track back to the partner who contributed the corresponding property. So if my property either gets sold, gets distributed to Asel, or I take back Asel's property in distribution, I am going to trigger the 704C and 737 mixing bowl consequences, and my $500 built-in gain is then going to be recognized. Why do these rules exist? These rules exist to prevent trafficking in built-in losses and built-in gains, and to prevent the partners from avoiding recognition when, if they dispose of those assets outside the partnership context, they'd have to recognize. That's a nice 2 to 3 minute overview of an extraordinarily complicated topic. I'm going to give you a very quick illustration. Here, of course, it's gold is going to go ahead and contribute the lavender property. You've got a fair market value of 800, basis of 300, your built-in gain is 500. If that property gets distributed to blue, gold still has to recognize. In addition to that, if green partnership sells the lavender property, while under normal circumstances you'd be able to take that 500 gain and allocate it under Section 704B among the partners, Section 704C overrides it and says that $500 gain is going straight back to gold. And then, of course, if gold takes back a different property, gold also has to recognize. Does not apply to distributions of money, although you do have to watch out for disguised sales, which I will address a little bit later. I am not going over ceiling rule and all this other stuff because we are just, in the interest of time, we don't have enough time to address it. So I'm going to skip over it straight to the considerations in each of these different forms. As I was saying, in assets up transactions, the beauty of this is So you can customize mixing bowl effects because you can just customize distributions of assets back to contributing partners in liquidation. And again, since you have to liquidate, if you're using safe harbor allocations, you have to liquidate in accordance with positive capital accounts. Usually speaking, you'll be able to take back the property that you contributed unless extenuating facts and circumstances apply. If those assets are going to be distributed to different partners in liquidation, you got your mixing bowl rules are going to kick in gain recognition, which is a problem. Assets over, right? In assets over mergers, you're not going to have any triggering of mixing bowl consequences right away. The problem is you've got multiple layers, which I illustrate in later slides, but the theme is, first you've got partner contributing to partnership, then you've got partnership contributing to new partnerships. So, I go back to this example, right? The green partnership is contributing to red and taking back interest in red partnership. Let's just say, this is a built-in loss property, but if we go to this example in which we've got an 800 fair market value and a 200 basis with a 600 built-in gain. Let's say after gold contributes to the lavender property with those attributes, then you have a second contribution when the fair market value goes up to 1,000. Well, you've got 200 that accrued under the ownership of gold, sky, and brown, and then you've got 600 that accrued under the ownership of gold. So if green contributes lavender property to red partnership, and red now owns it, if red goes ahead and sells, same principles. You can't allocate among the red partners in accordance with the profit loss provisions in the agreement. You've got to track back 600 to gold, and you got to track back the other 200 divided evenly among gold, sky, and brown. And that's in general the way the layers work, which is, it's all illustrated here. But all you have to keep in mind is if you're going to do an assets over merger, you got to track these layers, which can get rather onerous from the accounting point of view. And if you're the lawyer, you're probably going to have to help the accountant out unless, again, they're at a big four accounting firm or a major regional firm with lots and lots of resources. In assets over divisions, unless you've got a regulatory exception, which, again, in pro rata, simple pro rata divisions or vertical slice divisions, things like that, you may escape mixing bowl consequences. But if you're dividing up, you're going to have a serious problem. I've used always in bold. I sort of, ever since making these materials, I've backed off that. You don't always have mixing bowl consequences in assets over divisions, but you really have to watch out to figure out how this transaction is going to go down, because once you map everything out, you're going to realize that unless you do some very, very careful planning, you're going to have a shift of the assets from certain partners to certain other partners, and it's very tough to get out of mixing bowl consequences that way. So this is a nice overview when you're talking about issue spotting. Assets up. You can plan to customize the distributions to get around your mixing bowl consequences. That's a cool feature of assets up. Assets over mergers, you don't have mixing bowl consequences, but you've got to be careful to track these layers. And in assets over, in many instances, you're going to have mixing bowl consequences. And again, there are regulatory exceptions that you can dive into Section 708 and you can take a look at. So moving on, disguised sales. This is the general outline. I'm assuming most of you know this, right? You have direct or indirect transfer of money of other property, partner to partnership. Then you have transfer of money of other property, partnership to partner. And when viewed together, they're properly characterized as a sale. You have, of course, a 2-year presumption when it comes to the regulations. The regulations say if the 2 transfers occur within 2 years of each other, there's a rebuttable presumption of a sale. If it's more than 2 years apart, it's a rebuttable presumption that it's not a sale. Then you have mandatory disclosure, although weirdly there's no penalty for it, on Form 8275 if two such transfers, if any such transfers are going to occur. The thing you have to watch out for, right, and I've said accountants' responsibilities, but this is really the deal team's responsibilities. Sure, there's filing the form, but that's really academic. The thing you have to watch out for is of course, since contributions are always being made and distributions, are always being made, you have to figure out, it's not really the transactions themselves. So in other words, the contributions and distributions for any reorganization, merger, division, they're not really going to result in disguised sale consequences by themselves. In a bubble, that's not your issue. Your issue is things that occur in close proximity, either before or after. So when you're planning these reorgs, one of the things you got to ask if you're new to the client, you got to ask, okay, what distributions or contributions have occurred prior to the reorg? And then you'll look after the reorg, and then you'll see whether or not the clients are going to make contributions or distributions after the reorg occurs. And that's the key. When you're getting together with the deal team, you're asking, all right, what's happening in close proximity to the reorg? Because, again, when you get experience with this stuff, you're going to see somebody's trying to game the system, something doesn't pass the smell test, or even if it's innocent, even if the client has no real intention to actually have a disguised sale, you might still have the issue anyway. The way that things might look to the IRS might not be the way that it looks to clients who know the situation and have the best of intentions. So when you're talking about disguised sales, the issues are not really in the transaction itself. It's in what happens in close proximity to the transaction. That's your issue spotting checklist, right? Whether or not, if something happens in close proximity, you can properly view that in conjunction with the reorg as a potential disguised sale. I'm not going to get too deep into, since we're running out of time, the whole idea of disguised sales of partnership interests, which the IRS has lost on in court twice. But if those regs ever change, you may have problems there too in close proximity to reorgs. But keep an eye on this as you're planning these transactions. In a recap, the one other thing to note is capital shifts, right? If you've got a liquidating distribution or some other major distribution following a capital shift, Section 707 is going to get you in trouble. So watch for whether, in conjunction with a recap, if you have a liquidating distribution that follows a capital shift, you've got a Section 707 problem. Finally, the last thing to note on this is, you'll notice in the last bullet point, I'll try to fast forward to the diagram on pro rata and vertical slice divisions, but what that basically says is, or actually I have it right here. You'll get a clean, even slice or a clean pro rata slice of both profit loss in the resulting partnership and percentage of each asset inside of the partnership. On the other hand, if you got a horizontal slice or you got a non-pro rata division, right, that'll start giving you disguised sale issues. So instead of dividing the green partnership, if it's me and Asel in the green partnership, and we divide where each of us is getting half of the orange property and the moss property, even though for business purposes there's no real logic in doing that, we're probably going to get around a lot of these major issues. On the other hand, if we're going to say, all right, we're going to divide, it's me and Asel, we own two properties and we now hate each other, and I'm going to go get orange and Asel is going to get moss, and we're going to go our separate ways. That's when you start running into a lot of these issues. You run into mixing bowl issues, you run into disguised sale issues, you run into shifts, you run into all sorts of stuff, right? So this diagram is a very simple illustration of when do you run into a lot of these major issues. It's if you're trying to slice up assets in the partnership where, if you were doing this outside the partnership context, there'd be recognition anyway. Let me see here. For liability shares, it's relatively simple to do. I'm not going to touch on that for the next minute or minute and a half we've got, because really all you have to do is you have to go through your 704 and 752 regulations and just do a before and after comparison. There will be deemed contributions, there will be deemed distributions under Section 752, and then you'll evaluate the consequences as necessary. So that's the liability shifts. And then, of course, you have hot assets. What's the summary on hot assets? For Section 751 purposes, I personally think the new proposed regs on Section 751 are pretty nifty, because they get to the heart of what you're trying to track, right? What's your Section 751 share before you reorganized, and what's the Section 751 share of each partner after you reorganize? If there's a change, then someone's going to have recognition of income. So, the general principle is outlined here, and then you just have to do a before and after comparison as far as Section 751 is concerned. If you have any shifts, that's a real issue. I'm not going into Chapter 14. You can read the slides. If you want to discuss Chapter 14 with me, just send me an email. I'll be happy to do it. But you've got Section 2701 and 2704 consequences, which are only relevant in the estate planning context. So so that is going to about wrap up the 30,000-foot view. I know I went quickly, and I know I covered a lot of ground, but I hope what you got out of this is you got a general checklist of what you need to look for in these transactions, what types of issues might come up, and a few options you might have on the menu to plan around some of these nasty issues if they ever pose a problem. So again, feel free to contact me anytime you like. Send me an email. If you give me a phone call, I won't be guaranteed to answer it, but I'll try to get back to you as soon as possible. And and I'd welcome the discussion. So thanks again for listening, and I think we've saved a couple minutes for questions. So Asel, I don't know if you've got stuff on the display.
I don't see any questions so far from the audience, but I have a question for you. It was a great presentation, thank you. And just kind of in general, from your experience and practice, what do you see? What type of transactions do you see that are more common? For example, would it be an asset over, an asset up? And what is the reason for that? Is it just because the default is the asset over, or maybe there are other reasons that people like to do in real practice?
Sure. So in practice, what you're going to find in the simplest transactions when it comes to for instance, mergers of LLCs, taxes, partnerships, the most common is going to be assets over. Why? Because you can take any state law form and it'll be recharacterized into assets over by default. So in that respect, assets over is going to be more common. You're going to see it, and and it'll be implemented just simply by default based on the idea that, hey, we want a certain state law form for non-tax reasons, and assets over is just going to apply as default. On the other hand, assets up will be used very often in transactions where the partnerships don't have capital as a material income producing factor, right? Meaning, they do, right? So you have assets like real estate, you have assets like intellectual property that you may have Section 197 concerns. You've got tangible personal property where you got Section 1245 recapture. You've got mixing bowl consequences. If you've got asset heavy partnerships, assets up is going to be nifty in certain situations. But if you don't have capital as a material income producing factor, so if you are in, for instance, service partnerships, law firms, accounting firms, brokerage firms, and you're going to merge them together, you're going to divide them somehow, that's going to be assets over basically all the time, because there's no real concerns with a lot of these asset-based shifts. You don't have disguised sale concerns so much, you don't have mixing bowl concerns so much, and that sort of thing. So that's the division of how this stuff works in practice. But in the meantime, assets over, you're going to find, is the predominant form.
Thank you so much. Yes, that was very helpful. So I think we're about running out of time. So, and I don't see any more questions. So with that, we'll conclude our presentation. Thank you for joining us, everyone, today. To learn more about the ABA Young Lawyers Division and the Tax Law Committee, you can visit americanbar.org/young lawyers. And of course, if you have any questions, please feel free to email Matthew or myself. With that, thank you very much for joining. Take care and have a great day. Thanks.